This is TreppWire Week in Review for the week ending December 29th, 2023. I'm Haley Keene with Trepp, a data, modeling, and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Research Director. As the holiday season creates an expected slowdown for the markets, now is the time to take stock of 2023 and take a stab at what we can expect for 2024. With the news from the Fed about interest rate cuts coming in 2024, there are sure to be changes. But the question is how quickly those will come, and will CRE fundamentals need more to shift their trajectory? Lonnie, let's start by breaking down the year from a numerical standpoint.
Thanks, Haley. It's really interesting as we round out this year. This is our last podcast of 2023, so excited and sad about that all at the same time. As far as the numbers go, I think this has really been a roller coaster year for the markets in the sense that we've had the beginning of the year unprecedented rate hikes. We've had mass hysteria if you look at the headlines around office and other asset classes. The 10-year has gone up and down. The 1 month, the 30, like whatever you measure, if you look at 30-year mortgage rates, they've been all over the place. But when everything settled down, when the dust has settled, let me just give you a rundown looking at this year end to year end. So for the 1 month treasury, 12/30/22 as compared to 12/22 of 23. In 22, 1 month treasury was at 4.12%. In 23, 5.54%. Some volatility there. You see a definite spread change in the 1 month. But if you look at the 10-year, which most of the CRE folks use for their peg, 12/30/22 is at 3.88%. 12/22 of 23 is sitting at 3.9%. So if you look at that, you may surmise that it was a fairly mundane year, but the peak in 23 was at 5%. So we know what happened when that takes place. Lenders really start to pull back. The markets really start to slow down, and we'll have some other numbers as we talk through today that kind of highlight where the market has been. So if you look at it just on a graph, a year end to year end, it looks fairly mundane, but we know that 12 months between 22 and 23, we've seen a pretty big roller coaster. If we look at issuance outside of interest rates, CMBS was down 46% from 22 and down 65% from 21. 21 was really just a high watermark year coming out of COVID where we were shut down for a few months in 2020. So 21 really came roaring back. 22 was still super strong. 23 obviously has been subdued. So if you look at total issuance in 2023, we're looking at about 39 billion. Just for reference, 22 was 72 billion, 21 was 118 billion. And then CRE CLO issuance, which is that short-term bridge floating rate deals, usually 24 to 36 month term. That's down 70% from 22 and 80% from 2021.
When I think back to the predictions we made last year, it's almost comical, really. What we were calling for on the 10-year, and we were thinking, okay, strong possibility of some form of recession. So we were thinking the Treasury could be, sub 3%. My call was, I think, 3 to 3.25%, and more broadly, upper bound 3.5. So in a funny way, we've come full circle on the longer end of the Treasury curve this year. Now, looking ahead to next year, what makes me think that 2024 could be a much better year is that if you look at the forward probabilities of the Fed rate cuts, if we start getting a 25 basis point cut as early as the March 20th meeting here, and what that could mean for issuance, in 2023, I want to say it was about 81% of all issuance across every product type. So private label CMBS, agency, and a little bit of CRE CLO issuance we got, a predominant amount of that was backed by fixed rate loans. And so if we start getting the cost of capital coming down, my hopefulness is that we could see issuance tick back up here for 2024, and maybe we grind back to 50 to 60 billion. So that puts us up maybe 20, 30% under a base case. I don't know. I would find it hard to believe that we'd see just this massive wave of issuance coming, given that funding costs are still very high. But thinking about what we saw in the last part of this year on new issuance, spreads came in pretty strongly to the point that deals were oversubscribed, I think, fairly significantly compared to what we've been seeing throughout the year. And so if we continue seeing spreads grind tighter, and we might start off 2024, similar to what we saw in 23 with the AAA rated bonds, the last cash flows coming in, I think somewhere between 15 and 30 basis points is what I recall. And so if we start getting that again for this first quarter of 2024, then what that tells me is you probably will get a good amount of book building. And if we continue seeing some green shoots across certainly the office sector, hopefully we'll get that issuance pipeline filled back up. And so it'd be great if it did tick past 60 billion, but at least for right now, I'm kind of leveling off right around that 50 to 60 billion range.
So we'll do some deeper predictions here in just a little while across some other topics, but I agree with you, Stephen. I think that 50 to 60 billion is probably the most realistic outcome for 2024, just given what we know today. Now, the one thing that's interesting about 24 as we start to talk about predictions in a minute is just it's an election year. You still have an insane amount of geopolitical challenges across the globe, any one of which could really derail issuance, could really slow things down. So I think we have some caveats to say, some of our predictions we based on, the world maintaining whatever it is today, which what I wouldn't consider normal, but it's become the normal for us at this point where you have conflicts and wars going on and you have the risk for even more systemic challenges. So let's talk a little bit about delinquencies as we wrap up the year. So if we look back at January of 2023, overall delinquency for the CMBS market was 2.94%. The office delinquency in January of 23 was sitting at 1.83%. And, we were expecting delinquencies to increase. We were expecting the markets to slow down. We saw delinquencies jump up pretty significantly over the year. And again, this is another one that's kind of taken a little bit of a roller coaster where you had certain asset classes that really spiked and then now have kind of leveled off and even retreated some. And so if you look at our most recent delinquency data, which was November of 23, our December data will be available here in the next couple of days. Overall delinquency was 4.58. So again, 2.94 in January 23, 4.58 in November. We're expecting December to come in very similar to the November number, somewhere in that 4.5% range. If we look at office in November, it was 6.08. So again, 1.83 in January, 6.08 in November. I'm not shocked by either of those. I think the one takeaway for me is just the headlines move way faster than the markets. And I think that's played itself out this year. So if we were looking at the headlines, in any given sector at any given point in time, you would probably think the markets were way worse than what we actually have seen. So office being the worst asset class in 23, lenders don't want to make loans, borrowers can't refi, no one wants to pay market value, previously determined market value. They're suggesting that current market values are 50, 60% haircut off of those values on the previous trade. We'll talk about some of those today. But honestly, if 6.08%, Stephen, to me is just not off the charts. I mean, it's high, but it's not as bad as I would have expected given, what the headlines would suggest.
I completely agree. And what I thought was pleasantly surprising throughout this year was how quick some of the modifications came through. So if we were to use the rule of thumb that we got from the 08 crisis, the GFC, we would have thought, well, gosh, some of these modifications might end up taking about a year. And that distress just builds up in the headline number. We've had a fair amount of churn in the office delinquency rate. So, certainly if it had taken about a year to get some of these modifications worked through, I think we would have seen, 7% probably easily. And so that's the healthy part of the system, kind of learning from our past distress. So to the extent that continues, one of the stats I went back and tried to extract out of what we saw in office loan performance of 2023 was that of maturing loans, both hard maturities and soft. So the soft maturities are those loans that have embedded extension options. So when the loan comes to its maturity date, they can extend it for another 1 year. And it might have 3 of those options embedded. So if we're looking at that collective universe of office loans, about 20% of them ended up going into default or delinquency in 2023 without a resolution. So that 20% excludes loans that did get an extension either through modification or because they ultimately were able to work through, maybe there was a breach in the covenants where they technically didn't qualify for an extension, but ended up getting a waiver of that. And then we're still able to execute that 1-year extension option. So I removed all of those out. So this was really just this more serious delinquency problems. And that was about 20% of maturing volume.
Yeah, it's really interesting. I think learning from the GFC really has helped stymie some of that bigger, broader, widespread type of distress, because people have realized the extend and pretend generally works so long as you have borrowers that are engaged, that are trying to manage the property, trying to lease it up, trying to do what they can to keep the property viable. It works out better for the lender to continue to let them do that versus forcing them out, taking the property back, and then selling it at rock bottom prices. I mean, not all properties have been able to get modifications, extensions, and we've seen some really, basement bargain type of sales prices. But on the whole, to your point, it's really helped kind of keep the market afloat. So I know as we kind of wrap up this intro, this is taking a little bit of different approach given that it's year end. So we did a little bit of year in review, and we're going to start looking at some predictions here in a moment. But we just wanted to highlight a couple of things. On the podcast, we've been coming to our listeners every week now for over 3 years. We put out a lot of commentary, research, and Haley will talk about that throughout the podcast today. But there's a couple of things that we've seen from our experience in the market is just that with all CRE downturns, and guess what? There always is a downturn. Real estate by definition is cyclical. And so you have runs where the market's on fire and things are selling and cap rates are compressing. And then you have macro events that happen. Interest rates go up, desire or demand for those properties comes down, and the prices are commensurately reduced in value. And so what we've seen is some of those dynamics playing out in the market over the last year. And I guess the reality for us is the CRE market, and you guys have heard me say this on the podcast multiple times, by definition, it's a local endeavor, sometimes hyper-local. And what we've seen with these disruptions is it doesn't annihilate the entire CRE ecosystem. So you may have some property sectors that are more adversely impacted than others. And you have some that even in the face of a downturn outperform and do better than they've had done in the previous stretch, which maybe wasn't a downturn. So a couple of high-level takeaways this time. Industrial properties, through COVID, post-COVID, with crazy interest rate increases, with uncertainty around CRE lending environments, have still outperformed. Lenders are still making significant volume of loans to industrial operators. Rental rates in that sector are continuously increasing. Weighted average lease term that are shorter in duration, those assets are being treated as more favorable than those with locked-in long-term leases, given the fact that people still see upside on the rental rate side. Cap rates are stable, maybe compressing in some markets. If you look at retail, a lot of the retail subsectors, so we had a guest podcast this year with Strip Mall Guy. We've had several others that have come on and talked about the retail sector. Super resilient. If you looked at the retail sector in 2007, 8, 9, it was the retail apocalypse. We've now called it the retail renaissance. And the data suggests that there's no slowing down for the retail sector. All-time highs in rental rates, lows in vacancy, and the availability of capital for those assets have remained really, really strong. And a couple of other just anecdotal takeaways. While sales transaction volume is down significantly, depending on whose research you rely on, some say 40 to 70%. So assume it's somewhere in that range. The number of transactions that were 50 million and above were still really strong this last year, specifically in the multifamily sector. We saw a lot of multifamily properties trade with really low cap rates still at that 50 to $100 million price point. Same with hotels. It's been a really solid year given the downturn. So I would say it's kind of an oxymoron, but how can it be a good year when issuance is down, 40 to 70% year over year? The reality is there was still issuance, there were still transactions, and the properties that transacted at what I would say are more fundamentally supported or fundamentally sound terms than what we saw in 21 and 22. So from an outlook perspective, we're actually maybe getting to a more reasonable equilibrium of market fundamentals where buyers and sellers can transact, both sides can win. And with the news of the Fed rates potentially coming early in 24, I think that hopefully accelerates that trend. So just before we transition to predictions, Stephen, any other thoughts as we wrap up 2023?
I'll speak to the Fed interest rate issue just a little bit, because this was a very thought-provoking conversation I heard maybe about a week or two ago, that one of the dilemmas the Fed faces right now is that through 2023, we were able to import global deflation. So to a large extent, a strong US dollar and then a weaker global economy that had some straight disinflation or deflation trends, the US economy benefited from that. So going forward, what would be damaging would be if the Fed did cut rates aggressively, the US dollar drops in strength, And given the geopolitical situation, it's pretty easy to paint a picture where supply chain issues pick up and you have inflation now being imported back into the US. And so I think the Fed is going to have a very narrow path here in cutting rates, trying to maintain some level of dollar strength, or conversely, avoid too much dollar weakness that could potentially reignite inflationary concerns. And you hear that, I think, a little bit more in the European Central Bank narrative. So, for the calls out there to say, oh, I think the Fed will cut, not just 75 basis points next year, like they've said, we think that it could end up being 150 basis points. You really have to look at this from a global perspective. And if you're cutting that much, that's a pretty big hit that you're taking out of the currency. Anyway, I just wanted to mention that now, that if it seems like there's some hesitancy to lean too much into rate cuts, that's at least my perspective. I appreciate that global perspective being lent.
Yeah, I think that's fair. And I think, listen, we could talk about this for 2 hours if we wanted to do a full recap. We had 3 major bank failures this year. We have a lot of other things that we've covered through our research, we've covered on the podcast at length, that we'd love to talk through today. But we do want to get to some predictions. We want to do some other stuff. So Haley, why don't you tee us up on some stuff that we can put our names next to?
So we are going to hold you guys to this. No, we won't. We do this every year. And if you want to hear last year's predictions, you can go back and listen. You guys talked about interest rates, issuance, delinquencies. So why don't we start with interest rates, and you can break down what you think we'll see in 2024.
Since I just got done talking about rates, I will throw my dart at the board. Last year was a big old miss. I think my call was 3 to 3.25. So if at first you don't succeed, try again. I'm going to say 325 to 375 as the baseline. If we do get, flight to quality due to some concerns about geopolitical tensions, sure, maybe we could end up toward the lower end of the range. But for right now, I'm just going to keep it really boring and say, a wide 325 to 375 base case if we avoid any sort of a hard landing or medium soft landing.
Yeah, I'm in the same range there, Stephen. I don't think I have really a lot to add there, other than just saying I think this one is probably most sensitive to the geopolitical and some of the other items that we talked about earlier, of going off the charts in either direction, depending on where we're at globally.
So, Stephen, you kind of touched on this when you talked about the yearly stats, but tell us what you're locking in for your issuance prediction.
So for issuance, I mentioned earlier, somewhere in that 50 to 60 billion range. That's still my hope. If we get really some more weakness in the headline and things trade sideways to negative, maybe that ends up being really similar to what we got in 2023. They're right about 40 billion or so. But for right now, I'm going to try and stay with my glass half full and say around 50 to 60 billion in private label CMBS issuance.
I agree with you as well, Stephen. I think on the base case, you're probably looking at 50 to 60. I do think the market could be better than that, though, given kind of the ramp up that we've seen in the fourth quarter this year. As you mentioned, deals being oversubscribed and there being just a general sense of optimism. However, I still feel like even with the rate cuts, like those rate cuts don't immediately translate into, lower cost of capital widespread across the markets. And lenders are still going to be on, a little bit not so solid footing, I would say, relative to like trimming their books back, their exposure, et cetera, et cetera. And so there are certain asset classes like office that are not going to be favorable with lenders. You're probably going to see a pullback at some point in industrial. We've already started to see some signs of multifamily weakening. So, I'm optimistic that we'll get to that 50, 60. I'm hopeful that maybe it's 70, but I wouldn't be totally surprised if we saw another year maybe in that 45 billion range, which was slightly better than this year, but not as dramatic as we're hoping for in the base case.
And I know we've made predictions for delinquencies throughout the year, but where are you guys at now?
So this is the one where I think the market just moves slower than our mouths and then the headlines, in the sense that if you look at the GFC, we didn't hit peak delinquency until about 3 years in. We actually, accelerated that during COVID. We hit peak COVID delinquency in like 90 days, but that was completely artificial in the sense that nobody knew what the heck was going to happen and everyone was locked down in their houses and no one paid anything. I think in this instance, I wouldn't be shocked if we see overall delinquency stay where it's at or maybe decline a little, but I still think the office sector has more delinquency built into it. I think you're going to see an uptick in multifamily delinquency. I wouldn't be shocked if you see multifamily in the 4 to 5% range by year end 24. I wouldn't be shocked if we see office hovering in that 6 to 10 range, kind of where we're at now. And I think overall probably stays somewhere in that 3.5 to 5.5 range by year end next year.
Yeah, I'm there with you. I think, we could touch 5, maybe peak 5.5% during the year, but that would be a pretty bad outcome. I would say we would need a lot to go downhill over the first half of the year to get there. So my hope is that, maybe we breach 5%, but ideally maybe we peak out around 4.75%. Because we look at what office started the year at, it was just under 2%. It hit 6% in November. And so with the headline number going from, call it just about 3% up to 4.5%. So that was about 150 basis points versus, a 4% climb in office. Office, even if it goes up to, say 7-8% here over the next 6 months, that's going to have only a 25 to 50 basis point impact in the headline rate. And that's assuming everything else stays constant. So it would really take multifamily deteriorating, a continued weakness in lodging. I don't think industrial is going to contribute really much at all to this number. So it's going to take multifamily and lodging probably contributing a lot, because to what you mentioned earlier, I don't see retail adding a lot to the headline number.
Agreed.
And finally, CMBS lending spreads. What are you seeing there, Stephen? It's
funny, when we were going through all of the year-over-year changes in interest rates, and you look at CMBS spreads on the AAA, it's really stayed almost about the same place, even though we had a lot of mid-year volatility. So we started out December of 2022 at 130 basis points over the Treasury, and we ended this year, right now we're about 125 basis points. And I want to say by about February of 23, when we were seeing a lot of strength in new issuance before the Silicon Valley Bank collapse, I think maybe we touched 110, 112 type level. So I think we could easily get there within the first quarter of this year. And if we continue seeing strength, there's really no sign of a recession coming into play. I think we could come inside of 100 basis points here at the start of the year, because if we step back and think of how attractive CMBS is in the scheme of things, where we're at with rates right now makes bonds a very attractive carry trade. And so if we think we're at the peak terminal rate and we'll only be coming down from current levels, what that means is you're buying a very good carried interest rate if you're a bond fund, a money manager. And if rates do come down, those bonds that you're holding will then trade at a premium. So if you do want to trade out, you get some really good price action, appreciation that you'll be able to book if you sell those bonds. So that's why I think we have some pretty good room to run here in AAAs. Now, I will say, if we look at the BBB minus level, we were at, in December of 2022, 625 basis points over. That moved to 875 as of December 22nd in the past week. So obviously we'll want to see the BBB minus come in pretty strong from here. But again, I think we will see that if you start getting broader conviction that we've reached, not just the terminal overall interest rate, but also overall level of distress. And we start seeing more green shoots than crabgrass.
We'll start to see that optimism turn into activity, supposing the Fed comes out in March and makes a 25 basis point cut. And it signifies that we've reached terminal rates, and the markets start to transact with a more optimistic, bent towards the marketplace. Again, it doesn't mean that the distress is over, but it probably means that it'll be pocketed at this point, at least the perception. It's always been pocketed, but the perception will be more of a pocketed distress, and the market hopefully will start to function more efficiently, like it had, leading up to the interest rate actions by the Fed. So I think you're right in line with what my predictions would be in 24. And just amazing as we kind of close this segment out, like the volatility mid-year across a bunch of these variables all told the same story. I mean, significant volatility, but if you look at the rates, basically a push year on year for most of them.
So listeners, feel free to grade their predictions or send us yours. Tell us what you're thinking as we head into 2024. And although we started this off by saying it was kind of a quiet week for the markets, It wasn't that quiet of a week for CRE stories, as we had a lot of coverage in our daily newsletter. If you're not signed up for that yet, send an email to podcast@trepp.com and we'll give you the info and get you signed up. But let's dive into some of the property type stories that we're watching as we close out the year. We can start with office, and some of our biggest stories we would call mixed greens for the market.
This first one is good news, bad news on Madison Avenue. This is according to a story put out by The Real Deal. Ralph Lauren has signed an 11-year lease renewal for its office space at 650 Madison Avenue, which is near Central Park. So on the face, that's great news. It's great news for the CMBS bondholders and for that loan. The part of this that makes it a little bit of a mixed green is that Ralph Lauren is going to be downsizing its footprint by about 40%. So while they locked in a long-term lease, which is great for the office owner and great for the tenant, they are right-sizing this footprint to be more accommodative of their needs now, which is about a 40% reduction. So if you look at the property in total, it's about 600,000 square foot. It's at Madison Avenue and 59th Street. Ralph Lauren currently occupies about 37% of the square footage, and most of their lease space, which is about 195,000, had a lease expiration in late 2024. There was another 28,000 square feet that was set to expire in 2027. We like to see this because it shows activity, even though there is a downside. But again, if you're a TreppWire podcast listener, if you're a client, you would have heard us talking about this tenant for multiple years. So in 2023, we noted that Vornado had written down the value of that building, 650 Madison, to zero. At origination, that building was valued at 1.2 billion, was then lowered to 800 million, according to the appraisal documents in our system. And then previous to that, we noted that Ralph Lauren was looking to reduce its North American footprint by about 30%, which ties in nicely with this lease renewal showing that they're downsizing about 40% in this particular building.
So up next, we have a Cleveland office move that's good news for one office, one CMBS asset, bad news for another. So Cleveland.com reports that Oswald Companies will be moving its Cleveland office to the Ernst & Young Tower, which will be renamed to Oswald Tower in 2024. So this move by Oswald Companies came with building naming rights. That property is 950 Main Avenue in Cleveland. So this is in the Flats area of Cleveland. So this backs a $75 million Ernst & Young Tower loan. That's the only remaining asset behind a 2019 deal. That loan was slated to mature in late 2022, and there was one last 12-month extension option for the loan, but apparently the loan did not qualify for executing that extension. So the loan was reported as beyond its maturity date for the last year. In early 2023, we had a TreppWire story that noted that Ernst & Young would be leaving the 475,000 square foot tower, and E&Y had 14.7% of the space on a lease that ended last week. The value of that property was lowered from $134 million in 2019 to $68.25 million this month. The new lease to Oswald Companies is obviously a strong positive for this loan, and hopefully will give us some resolution around ultimately what will be possible, given that this loan has been past its maturity date for about a year now. So the negative side of this story is that Oswald will be leaving 1100 Superior Avenue in Cleveland. That property is a REO asset in a 2014 deal. So 1100 Superior Avenue is a 576,000 square foot office that was built in 1972. And Oswald was the top tenant with 17.5% of that space on a lease that ends in 2025. The asset has an outstanding balance of $45.5 million, which represents 5.67% of the collateral behind this 2014 deal. Over the first half of 2023, the asset reported a debt service coverage on a net cash flow basis of 0.57 when the occupancy was 67%. However, the latest special servicing data indicates occupancy was down to 61%. That property was most recently valued at $16.7 million, down from $70 million in 2023.
Yeah, so that's a significant reduction in value, and we're starting to see these assets. I mean, we've talked about this, Stephen, with some of the retail assets over the year. Like, if you didn't make it through COVID, you're probably not going to make it. However, if you did, you're going to come out stronger. And I think this story gives us some of that indication. You know, for the 950 Main that's going to be getting Oswald to move there, really great news, solidifies them as a market player. for the 1100 Superior Avenue, which is already an REO, now losing 17% of its tenant base, value going from 70 to 16 million. This is one of those, I mean, like this is probably a land value type of play at this point. I mean, I don't know how much intrinsic value there is in the building at $16 million valuation on something that's about 600K square feet.
Yeah, I mean, this kind of tenant churn is why we refer to the office situation as a slow-moving train wreck, because what's good news for one asset is bad news for another. And given how far down effective rents have come, and really what's having to be offered by even the good buildings in the market right now is still lower than what we had projected, say, in 2019. So it's not just a flat, the sky is falling absolute negative, but it's still, there's some good news out of a lot of these bad news type situations.
So if you've been listening to us all year, you'll know that 2023 was the year of the sublease, and not in a good way. Across the U.S., firms were putting sublease space on the market hand over fist, and unfortunately, not many of those available spaces were taken by new tenants. So last week, we actually saw one of the positive stories, however. Lonnie, can you break this one down for us as we head into our green shoots section?
Yeah, so I actually think 2024 may be the year of the sublease in a positive way, right? So maybe we're starting to see this here. Duolingo took down about 86,000 square foot of sublease space in Lower Manhattan. So this was according to BizNow. They reported that Duolingo, which is a language technology firm, is going to be taking 86,000 square feet from Spotify. And this is at 4 World Trade Center. They've agreed to occupy the 26th and 27th floors from the Port Authority of New York and New Jersey, which Spotify subleases alongside their 478,000 square foot direct lease is signed with Silverstein back in 2017. So Silverstein has redeveloped that entire area, and Spotify was a major player there. So they expanded into the Port Authority space in 2018. They basically agreed to pay about 81 million over the course of a 15-year lease, which works out to about $61 a square foot. But they put this space available for sublease, and Duolingo has snatched it up now. So, not quite 100,000 square feet, but a really good sign for that sublease market that's been pretty downtrodden, as Haley mentioned, during 2023.
Unlock a historic mall investment opportunity with Spinoso Real Estate Group's proprietary platform. Their expert team excels in identifying unique opportunities and conducts rigorous due diligence. With a proven track record of operating over 86 malls and 74 million square feet, their turnkey operating platform is poised for strategic execution. Partner with Spinoso and seize this institutional historic opportunity. To learn more, connect with the Spinoso team at the CREFC Miami conference this January. So we have another green shoot for the New York City office market.
Yeah, so we've been a little New York City centric today, but for good reason. We've had a lot of activity in that market. And so there's more signs of life in the New York City office leasing market. Last week, we talked about, we went through a fairly long list of New York City sales and refinancings, which provided a lot of green shoots for the office market on the whole. But now we have 2 more green shoots across the leasing space. So 2 major Manhattan leases of several 100,000 square feet were announced in the recent days, which gives a big jolt to the market that was largely moribund in 2023. First, we have Bloomberg reporting that MetLife has agreed to extend its lease at 200 Park Avenue for another 11 years. In the article, they note that the insurer will continue to have 400,000 square foot of iconic former Pan Am building near Grand Central Station. The tower is now fittingly known as the MetLife building. I mean, if you come out of Grand Central, you can't miss it. Pretty iconic building. This one's of note. It backs a $1.4 billion 200 Park Avenue loan, which is slated to mature in 2025. So this is great news in the sense that MetLife occupies about 16.4% of the building space. And so we'll see how that building is able to refinance with its upcoming loan maturity here in the next couple of years. There's been several news outlets reporting that law firm Paul Weiss has signed on for 765,000 square feet. It's a really big number, 765,000 at 1345 6th Avenue, which is also known as 1345 Avenue of the Americas. The law firm is currently at 1285 6th Avenue. And this is a really big shot of good news for 1345 6th, and the fact that it's lost some big tenants over the last few years, which include AllianceBernstein. This property is backed by a $338 million loan on a 2005 CMBS deal. Financial terms were not revealed for this lease transaction, But given the fact that they had lost some notable tenants, the assumption would be that Paul Weiss got some pretty good lease terms there. But great news. So two, head start stories heading into 2024 of size and term for the New York office market.
Up next, we have some good holiday cheer for a distressed Pennsylvania office loan. According to the Pittsburgh Post-Gazette, Giant Eagle has signed a 100,000 square foot lease at the Cranberry Woods Business Park in Cranberry Township, Pennsylvania. Specifically, the firm will be taking space at 700 Cranberry Woods Drive. And that address is one of three buildings backing a $46.6 million Cranberry Woods Office Park loan. Now, that loan was not paid off at its maturity date this past summer, and the special servicing workout strategy had been coded as foreclosure. So the 700 Cranberry Woods Drive property was a single tenant currently on the rent roll with a lease expiring this month. And this loan, the 46.6 million Cranberry Woods office loan, is collateralized by three buildings totaling 346,000 square feet. So while the office complex contains four buildings, one of those properties does not back the loan. So with this new lease, the occupancy at the four properties will now exceed 90%. So there's a potential that we could see the workout strategy recoded from foreclosure here in the future if this new lease is as positive as it seems like on face value. And this note makes up just over 50% of the collateral behind a 2013 deal.
And just to add some context to that previous story that I read about the Paul Weiss law firm, that 765,000 square foot lease is considered to be the largest office lease in the city this last year. And while I said they didn't disclose the terms of the lease, we pulled together some data. It looks like the lower floors in that building have rents in the $80 square foot range, and then the upper floors are somewhere about $135 a square foot. So just to add some context to the previous story there. We did have a couple of other that we'll run through quickly. So 132,000 square foot office property in Canton has sold. So Huntington Plaza, which is at 220 Market Avenue South in Canton, Ohio, has been acquired by an undisclosed buyer, and this is according to the real estate journals. The office complex was constructed in 1985. The sale does include an adjacent parking garage. The property backs $7.37 million Huntington Plaza portfolio loan, which currently makes up less than 3% of a 2013 deal. The sales price was not disclosed. However, the value of the collateral has been lowered below the balance of the loan. The collateral was valued at $12.54 million in 2013 on a pro forma basis and $9.4 million as is. The most recent valuation is $3.875 million. So this is one where they had a stabilized valuation projected out in 2013. The asset was being acquired with a value at play with the value in place at $9.4 million. And in practice today, the value is sub $4 million. And this asset had been sent to the special servicer early in 2022. So again, if you're the acquisition party or the buyer on this, you're really getting this at a favorable entry point, and you're hoping to recapture some of that lost value. Unfortunately for the seller, this didn't go to plan, and this is one of those that'll go down as, the market taking some distress and turning that as a negative for the ownership group. We did have one other positive story. Lennar Homes pays $68 million for some Miami offices, so about $319 a square foot for the 213,000 square foot 5505 Waterford at Blue Lagoon office building in Miami. The Miami home builder bought the 21-year-old building, which was developed to serve as Burger King's headquarters. They purchased this from Franklin Street Properties, which had purchased the property back in 2003 for $48 million. CBRE acted as the broker and arranged the sale, and Lennar was already occupying most of the property. The other tenant in that space is Unique Vacation. So I guess that's, a green shoot maybe on two fronts, Stephen, in the sense that you got a really nice $300 square foot office sale in Miami, and it's to a residential home builder, which could very easily have had a down year and really been trying to shrink its footprint, kind of making a statement here by saying we're going to purchase the building we've been occupying as a tenant for some time.
Sure, absolutely. And I think this also speaks to the strength that we've seen in Miami with just how much in-migration they've had. So looking at probably where some of the strength has been in the overall headline new home sales we've seen this year, every time rates dipped, new home sales came in surprising to the upside. So that resilience, I think, speaks to exactly this story that Lennar is staying committed and is very much involved for the long run.
All right, so we definitely have a lot more office and we had a lot of negatives this week as well, but let's pivot to retail and talk about some of the stories we were watching this week.
So retail has, as we mentioned, really become resilient in today's market. However, there are still some challenges across certain segments. And so today's story, San Francisco retail loan goes 30 days delinquent. This is one that we've talked about on the podcast before, but several months ago, T-Mobile was one of the many retailers to pull out of San Francisco. So now a CMBS loan that's backed by a T-Mobile location has gone 30 days delinquent. This is for a standalone 17,000 square foot T-Mobile store at 1 Stockton Street, and their lease runs until 2026. We haven't seen any termination option data in the prospectus documents, and we haven't seen anything in the commentary leading up to this. So we're not exactly sure why the loan has gone delinquent, but it now is being reported as 30 days delinquent. So property backs a $66 million 1 Stockton loan, which is split across 3 CMBS deals, but the special servicer and December comments were not noteworthy. It just says that the loan has gone 30 days delinquent. So this will be another one that we follow up on once we get some additional color, and just another indication of some of the challenges retailers are facing in the San Francisco market.
Up next, we have the value of a Connecticut retail loan was cut sharply. December remittance data revealed that the value of the collateral behind the $21.1 million Newington Commons loan had been cut considerably. The loan has been with the special servicer since May 2022, and the note makes up 2.1% of a 2014 deal that's part of CMBX 8. At securitization, the property was valued at $32.3 million. This month, the value was lowered to $13.6 million. For the first 9 months of 2023, the loan posted a debt service coverage ratio on a net cash flow basis of 0.63 when the occupancy was at 84%. And the collateral behind this is 189, almost 190,000 square foot community shopping center in Newington, Connecticut.
And then we'll round out our retail with 2 quick stories here. Manchester Parkade Shopping Center, which is a 350,000 square foot retail center located at 346 Middle Turnpike West. This is in Manchester, Connecticut. Was recently acquired by NNM Realty Trust and MNP Realty LLC. That's a tongue twister. This story comes from the Hartford Business Journal. Property backs $14.3 million Manchester Parkade loan, which is about 3% of a 2016 CMBS deal. Loan matures in 26 and is locked out until late 2025. For the first 9 months of 2023, loan had DSCR at the net cash flow of 1.04x when occupancy was 94%. Complex was valued at $22 million at origination in 2015. Sales price was reported at $19.2 million. So this is another one. Not great news, but not terrible. Phoenix area retail property sells for a big premium. So we got some good news here when compared to its 2018 sales price. Palm Valley Pavilions West, which is about 233,000 square foot shopping center that's located in Goodyear, Arizona, was sold for $59 million, which equates to about $250 per square foot. This story comes from the Phoenix Business Journal. Properties anchored by Best Buy, Total Wine, Ross Dress for Less, and Barnes & Noble. DRA Advisors was the seller. Additionally, Connect CRE notes that the property had last sold in 2018 for $44.75 million. So the latest sales price is about a 32% premium to that. The current buyer is affiliated with Raymond Arjmond. So Stephen, we've talked about this for the last couple of months, that like consumer drive up retail experience, Best Buy, Total Wine, or Specs, and Ross or TJ Maxx, Barnes & Noble, or Burlington, those centers seem to be doing really, really well regardless of geographic location. It seems like all of those anchored centers are selling in that $200 to $300 square foot range pretty much anywhere across the U.S.
I just have a hard time seeing consumer spending pull back that material, but at the same time, I will admit there's some pretty conflicting data points we get on consumer health right now. On the positive, I can't remember the last time I mentioned this, but we got a report from the CEO at Bank of America saying, actually consumer balance sheets are doing quite well. If you look at consumers that before the pandemic had about $2 to $4,000 in their account. Right now, they have between 10 and 14,000 still in their account. So not as much savings has been drawn down in the consumer segment as we would have thought, given the report from the Fed. So I think as long as we don't see the consumer's back completely broken here and a significant weakness in the jobs market, which we haven't seen thus far, hopeful that, as you said, 2024 continues to be another year of resilient retail.
And let's talk about a few multifamily stories quickly.
Yeah, so we're going to wrap up this podcast with some multifamily stories, and I think we'll be talking more about multifamily into 2024, given some of the recent trends. So this story comes to us from Connect CRE. FPA Multifamily has acquired a 399-unit, two-property multifamily portfolio in Thousand Oaks. Total sales price was 171 some change million. Los Robles Apartments, which is a 253-unit property and at 300 Rolling Oaks Drive. This was a 1972 vintage property that was renovated in 2019. Property currently backs a $59 million Los Robles loan, which is about 5% of a 2019 CMBS deal. That loan matures in 2029 and is locked out until July of that year. Debt service on this property was super healthy, 2.09x at net cash flow in 22, where occupancy was also at 99%. At origination, the property was valued at $93.2 million. The other property, the Retreat at Thousand Oaks, which is a 146-unit complex at 550 Laurie Lane. Property was built in 1966, so slightly older, was similarly renovated in 2019, has about a $41 million loan on it, part of a Freddie Mac deal. Complex was valued at $67.6 million back in 2019. So if you look at those appraised values in 2019, you're at about 120 million, 130 million. Property just recently traded for 171. So a lot of good news on that side. We also have a New Orleans multifamily loan that misses its balloon date. So this is hot off the presses, according to December remittance data. The $40 million Esplanade at City Park loan missed its balloon date this month. It's a 440-unit apartment complex at 3443 Esplanade Avenue in New Orleans. Recent servicer notes indicate the complex had damage from Hurricane Ida in 21. For the next couple of years, occupancy was held down. In 21 and 22, occupancy was under 75% as a result of the damage. However, in 2023, occupancy rebounded to 93%. And if you look at the financial performance through the first 9 months of 23, the loan posted DSCR at net cash flow of 1.13x. Even with the extensive damage, the DSCR never fell below 1.0x. And then two more. EQR acquires two apartment complexes. Reported cap rates on those deals at 5.1 and 5.4%, respectively. So Equity Residential has acquired two Atlanta properties. The first is a 344-unit Richmond Row in Sewanee, Georgia. That was acquired for $98 million or $285,000 per unit. The article attributes this quote to Equity Residential CEO Mark Parnell. This asset is brand new and is still in lease up, and we expect it will stabilize at a 5.4% year two acquisition cap rate. The second property was 290-unit Baxter in Decatur, Georgia. It was acquired for about $81.7 million or about $282,000 a unit. And the article states the acquisition cap rate or going in cap rate on this deal was 5.1%. And that deal also included a loan assumption, which we've talked about some of the benefits of that there. So I think Equity is making a play in the Georgia market, is saying that even though Sunbelt maybe is getting some of the macro negative headlines, there's still opportunity in that marketplace.
I mean, this is really interesting to see where cap rates have moved. So first off, this is a very healthy sign for me to see that we're no longer with a four-handle cap rate. We're pricing at least to a more reasonable level now. But if I step back from and think about where funding costs are for multifamily, if you're still looking at, say, a 6.5 to 7.5% coupon mortgage on an interest-only basis, let's take out amortization and make this math easy so that your cost of capital is, let's round it to a nice even 7%, but you're paying a cap rate of low to mid fives, you still have negative leverage here. So what this tells me is that the apartment market is still so competitive for assets that as long as we don't see again, demand drop off a cliff for multifamily, that you're really banking on, say, a lot of cash flow growth over a 10-year pro forma to get back to positive overall leverage. So I don't want to get too much into the professor math here of overall discount rate or cap rates and all that fun stuff. But to me, it still feels like there's still a little bit more upward pressure we could continue to see on multifamily cap rates if, and this is a big if, we don't see too much of a reduction in the 10-year treasury rate beyond what it's at currently.
So we'll have more. We're actually going to bring back some of the 101 sessions here in subsequent podcasts. So Haley's working on some outlines for us on that. And then we have one more story, and then we'll transition out to a shout out. So Tishman acquires the Chicago apartment building. This is according to the Chicago Business Journal. Tishman Spire paid about $128 million for a well-known property. Union West Apartments is a 357 unit complex in the Chicago's West Loop. Price amounts about $360,000 a unit. Properties at 939 West Washington Boulevard and is currently sitting at about 94% occupancy.
Okay, so let's jump through shout outs really quick. Yam R reached out. He's a recent graduate and is seeking a full-time job in commercial real estate. He thanks us for the podcast and really loves our data. Mickey really loves the podcast and has been a dedicated listener for 3 years. And we had a bunch of you reach out for the newsletter. So I'll run through some of those quickly. Bill M, Sam G, Michael V, and Jared H. And then Lonnie mentioned this earlier, but if you missed any of our guest episodes this year, we had a bunch of great people on from all across the industry who talked about a lot of different topics. But we wanted to give a shout out to all of our guests from 2023 and remind you all to go back and listen. It kind of gives a refresh of where we were in the markets at that time of the year, which was very different. So shout out to Danielle D. Martino Booth, Warren DeHaan of Acor Capital. We had 2 different groups of people invite us out to do live podcasts this year. So thank you to Emily D'Agostini and the team at ICSC for having us out to Detroit, and Mark R. and Brett K. from NAIOP Silicon Valley for having us to California to present live. Thanks to Bob Knackel of JLL, and Strip Mall Guy, Ethan Penner, the father of CMBS, Matt Frazier of Jones Street, Carmen Spinoza of Spinoza Real Estate Group, and Shlomo Chop of Terra Strategies. So if you didn't hear any of those guest pods, go back and give them a listen. And thank you to all our listeners for listening all year. If you're a new listener, we welcome you. If you've been there since the beginning, we thank you. And we always appreciate all the feedback, you hitting play on the episode, you sharing with friends, and we hope to see more of you in 2024. So thank you. And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.